Hey everyone, it's Brandon from the Young Investors Podcast. Myself and Hamish are excited to bring you your weekly rundown of the latest business and investing news from around the world. A quick reminder before we get started that any advice provided by myself is general and does not consider your financial situation, needs, or objectives, so consider whether it's right for you. Brandon Kolk is authorized to provide general financial product advice in Australia and is authorized representative 1305795 of Guideway Financial Services Proprietary Limited, AFSL 420367. Please see the description box for my financial services guide. Past performance is not a reliable indicator of future investment returns, but with that said, let's get into another episode of the Young Investors Podcast. All right, guys, welcome back to yet another episode. We are back. Hamish, Hodder, are both your ears intact, my friend?
It's a great way to start a podcast. Yes, they are. Yeah, that's
Holy
crazy, right?
smokes.
Because was it last week? Was it last week or maybe the week before they had the US presidential debate? And that was obviously a huge story in of itself. And we don't do politics really on the podcast here, but obviously I think we spoke about it maybe briefly. But yeah, the US election just keeps getting crazier and crazier. Oof. Of course, we're talking about the Trump assassination attempt on the weekend, which is mind blowing.
I mean, we joke about how it's kind of the most entertaining, TV show on the planet, but I don't quite want to push it this far. I don't want it to turn into. It's really crazy. Really getting crazy over there. So,
it's
also I just can't believe, we don't have to talk about this for too long, but I just can't believe that it actually happened. Like it could actually, like somebody could crawl up onto the roof, pull out a gun, get in position, and actually let a couple of shots off, it just blows my mind considering Secret Service are there, and also considering that you saw the footage of people like filming this guy crawling up on a roof and saying to the police, hey, look, there's this guy getting up on this roof over here. Yeah. So, it's really, really wild that it all kind of happened. But, I don't quite know what to make of it.
Yeah, I guess we'll probably, it's probably still really early to get kind of a full story on what happened. I mean, I'm sure in the coming months and such, there'll be full investigations and we can kind of figure out how this even happened. Because, I believe the Secret Service were aware of him before he started shooting, but they didn't have the authority to deal with it before he started shooting. So that's something, but again, like these are all kind of tidbits that are just kind of coming out in the days after. So I guess there'll be like a full investigation and then maybe one day we'll actually know. But it is kind of wild because it is such a serious thing. But I think also in the social media age, it so quickly becomes a joke at the same time, which is a very weird world to live in because it's obviously extremely serious. Attempted assassination, one person died, two others were injured in the crowd. So it's obviously a very serious and sad event, but immediately it's also just a massive joke and a massive meme. And it's a weird. It's a weird world we live in.
So, like, I've seen hundreds of memes already about people, like various takes and various jokes about it. And it's so weird that we just brush these serious things off so quickly. In the format of memes, like it's wild.
I don't know if that's like healthy or I don't know. I mean, I guess humor is just like a natural human way to deal with very serious topics, but it is strange to see it happen so quickly. It's bizarre, but anyway, so
it's wild, and so and to finish off that thought, we have actually got an interesting story in this podcast about the impact on the stock market because we're not a politics podcast over here. It's not our goal.
We're not,
but we are a stock market podcast.
We're not, and we fully endorse Donald. No, we're not doing that.
And Joe Biden, I'm Joe Biden. I approve this message.
No, we're not becoming a political podcast. Thank God. But
Definitely
yes,
not.
I do have a story we can talk about his impact or the event's impact on different financial markets. It's been kind of interesting to see. I've also got a story talking about Google making a massive multi-billion dollar or trying to make a massive multi-billion dollar acquisition I've got
okay.
we've got a story talking about BlackRock reported their earnings, and we'll talk about some things.
Talk a little bit about ETFs.
About ETFs, and what else have we got?
Yep, and then I'm going to be talking about some luxury brands slowing down, particularly in China, because things are getting kind of crazy over there. There's just no one's buying luxury goods at the moment. So it's quite a dense story. So work our way through that one as well.
Well, with that said, today's episode is brought to you by Seeking Alpha, your one-stop shop for stock analysis, market data, and news. Access expert analysis and news for thousands of stocks. View buy, hold, and sell ratings from members, Wall Street analysts, and Seeking Alpha's own algorithm. Screen for stocks using a variety of fundamental and technical analysis metrics. Access 10 years of financial data and company filings, and manage your portfolio by tracking your investments with price alerts so you never miss a buying opportunity again. Click the link in the episode description or head directly to seekingalpha.me/young investors to try Seeking Alpha free for 7 days. Where do you want to start?
Okay, well, let's keep rolling from what we were talking about in the intro with this Donald Trump news, because you've got a story about the impact on the stock market. You want to take us through that stuff?
Yeah, so interestingly, and I guess maybe not surprisingly, there has been so this happened kind of over the weekend, the assassination attempt, and then, come Monday morning, we saw a number of financial markets, the bond markets, the stock market, specific stocks as well, and even cryptocurrencies all kind of moving. And a lot of it can kind of be, I guess, based around this idea that after the assassination attempt, there is kind of this consensus that the likelihood of a Trump presidency has gone up in a significant way. And so markets are kind of moving based on that. And it's essentially been dubbed the Trump trade, which was a term I think was used during his previous presidency. And I'll get into kind of some of the details. But yeah, all of this kind of comes around this idea that a Trump presidency is much more likely now. And not only is a Trump presidency much more likely now, according to people who are analyzing this, but an actual complete Republican sweep is also going up in likelihood. So that would mean a Trump presidency, but then also a Congress that has both houses be Republican as well. So UBS actually has the chance of that, a complete Republican sweep, at 45% now. Which would mean that, of course, it would be not only a Republican presidency, but that it would be very easy for them to pass legislation through, which needs to kind of pass through both houses of Parliament before being signed by the president. So that's kind of like the backdrop, I guess, to some of the numbers we're going to talk about.
Yeah, it's so interesting how after all that's happened, the only thing that's come of it probably is that Trump gets the sympathy vote. Like, there's just a bit more sympathy because he's been shot in the ear. Like, that's just wild. And it's wild because, again, from our understanding right now, it sounds like we don't understand the political motivations of the shooter. But you would imagine, like, they clearly didn't want Donald Trump to be the president. So it's kind of crazy how this event, having failed, has now actually made it that much more likely for him to be the president.
Yeah, exactly. I think I don't know of one. Maybe there is one, but I'm pretty sure every time there's been an assassination attempt on a running candidate, they've had a sweep. So like Ronald Reagan, for example, was the last one, I believe. But correct me if I'm wrong. I'm not a super politics guy, US politics guy. But yes, that's kind of playing into this narrative that it's much more likely. The stock markets, for example, the indices, the Dow Jones rose 0.5% on Monday alone. The S&P was up 0.3%, and the Nasdaq was up 0.4%. And it essentially comes around this idea that if elected, there's a couple of kind of economic policies that makes sense for a stock market to be higher. So those kind of three key policies that I was seeing was more tariffs on imports, tax cuts, and then looser business regulations. And all three of those kind of economic-related policies are generally considered to be inflationary. So how does that work for each of these? If you have higher costs on imports, it's probably going to mean higher prices for consumers because businesses are going to pass those costs of materials or such through to consumers, or consumers will just have less choice. Tax cuts puts more money in the pockets of households and businesses, which means generally more spending, kind of throwing, pushing the gas pedal on the car and pushing the economy along faster. And then looser regulations doing the same thing. So those kind of the economic policies that seem to be what Trump would do are kind of inflationary. They're stimulative towards the economy,
which is good for business and good for stocks.
Exactly. And so not only did we see stock markets rise on Monday as a kind of result of this, but we also saw treasury yields on bonds rise as well in response to a potentially more inflationary environment. So you had the 10-year US bond rate jump from 4.19% to 4.23%, which is obviously, these are all very modest, changes. And we don't really care about this. Obviously, this is just like a daily, change in broad expectations. But it is interesting to kind of understand the market's kind of mindset, if you will, behind pushing treasuries up and pushing stock prices up because of a potential higher likelihood of a Trump presidency. We also saw, in relation to this, cryptocurrencies rise. Bitcoin rose just 6% on since Sunday, reaching almost $65,000 US dollars. So all of those kind of make sense around a more inflationary environment. Trump's own stock also rose. Trump Media and Technology, which is the parent company of Truth Social, his kind of Twitter social media site, surged 31% on Monday. So how's that? How's that for a...
Holy smokes.
Yeah, so,
Maybe we got to take the Young Investors podcast public and then someone can clip me in the ear and then we stand to benefit.
Yeah. Yeah, that's not a bad trade.
Wowee, that's wild.
One ear for 30%.
Yeah, 30%. Yeah, would you take it? I don't need 2 ears, I guess.
Yeah. So,
That's wild.
Seeing Trump's stock rise, I think, is probably not super surprising. And another one that also isn't too surprising are firearm-related stocks. So, Smith & Wesson rose 10%, and Bullet Maker Ammo rose 18%. That's the kind of normal reaction, I think, from firearms businesses or stocks after some kind of event is for people to load up.
True. That's true. That there's probably going to be higher incentive for people to. It's going to put it in the forefront of people's mind to go out and buy guns. I'm seeing it the other way though. I'm seeing now that Donald Trump has almost been assassinated by a gun, does that make it more likely for him to push gun regulation when he's in office? Maybe he's finally got the message that he doesn't like guns anymore, and maybe this change.
Yeah, wait a second.
Get me?
This changes the whole thing. Quick, change the Constitution.
Yeah. I wonder if he'll be so. I don't really know Donald Trump's stance on guns. I imagine he's pro people owning their own guns, but I wonder if his views changed just a little bit after recent events.
I don't think
Interesting.
so.
You don't reckon?
Maybe, I don't know. I'm not sure.
We'll just shake it off. It's all part of it.
It's part of the gig. That was basically it. I just thought it was interesting to kind of explore how kind of markets react to these kinds of events. Again, this means absolutely nothing for the long term, but I just find something fascinating about thinking of the market as kind of an entity that kind of votes. It is like it's a voting machine, right? As Benjamin Graham says, and it kind of votes on things, and it's interesting to kind of understand the mindset of like the manic mindset of the stock market as it kind of tries to predict what's going to happen. Even based on events like this. So there we go. That's the story.
Oh gosh, that is a story.
Yeah,
that's pretty. It is interesting. It is interesting. I don't know if I have any Strong opinions either way, but it is interesting to watch kind of how markets react to this kind of thing happening, how they perceive things. Well, Hamish, shall we move on to talking about luxury goods?
Yes.
Would you like a
You know me.
new handbag, Hamish?
Yeah. I'm a big luxury goods guy.
Hamish, he says to me, unpacks his bag over in the States, and he's just pulled out like 5 of the exact same T-shirt, just 5 of the exact same navy T-shirt.
But they're really,
Kmart.
from Kmart, yeah, really good quality.
Really
$5
good quality. So this is the type of guy that we're talking about right now, everyone.
Yeah.
You're the furthest thing from a luxury good, I think. Oh dear. But no, okay, enough digs. So I want to start with Burberry. So shares in Burberry plunged 16% on Monday after a disappointing fiscal first quarter performance led it to issue a profit warning, replace its CEO, and axe its dividend. How do you like that for the trifecta?
Jeez, it's a rough weekend.
Yeah, the 168-year-old British luxury giant said that if the recent trading slowdown continues, it expects to report an operating loss for the first half of this year and full-year operating profit below current consensus. It also suspended its dividend and named Joshua Schulman, who formerly led Michael Kors and Coach, as new CEO. Jonathan Ackroyd is stepping down, quote, with immediate effect by mutual agreement with the board, the company said. The company is consulting on job cuts to slash costs, Chief Financial Officer Kate Ferry confirmed to reporters on a call. These would mainly be corporate roles in the UK, and it means, quote, a few hundred jobs are likely at risk globally, she said. It's a pretty tough time for the. I think they make trench coats, if I'm not mistaken, or more outerwear. They're doubling down on their Britishness, I think.
Right. Okay.
But yeah, revenue for the 13 weeks ended June 29 fell 22% to £458 million or 594 million USD. Comparable same store, that's a hard one. Comparable same store sales dropped 21%. The company has been battling with a dwindling luxury appetite across its major markets, with the cost of living crisis affecting its European and US customers and economic concerns plaguing Asian customers. So the slowdown in China, a key luxury market, has hit brands across the sector, which we will talk about in a minute. But there you go. How do you like that for a trifecta of...
Yeah, it's
oh dear.
It's interesting to see because I think there is at least there's kind of a general kind of I don't know, I guess like an investing philosophy or an idea that that luxury brands generally do better than non-luxury brands during tough times because people with excess wealth continue to buy products. They're not the ones that are cutting back. But yeah, obviously on an individual business basis, and it can vary. And I guess China in this case probably plays. It seems like you're going to talk about how it plays kind of or at least it's played a meaningful role in this. So yeah, that's interesting to see. What you're saying is very true, Hamish. There's like tiers of luxury almost, where there are some luxury goods that are just so luxury, so expensive that they will just make sales no matter what, because even in the depths of economic depressions, like the ultra rich are still ultra rich. Yeah. Like there is no world where the Jeff Bezoses of the world or the like are just not excessively wealthy and can buy whatever they want. It just can't happen. Yeah. So you're right. There are some brands, and I think, for example, like a Ferrari is one of those brands where, they're always going to sell Ferraris. Even in the depths of recessions, Ferraris will still get sold. But there are these brands where they are targeting the luxury market, but they're not quite top-end luxury. I can't remember exactly what the term is, but it's kind of like luxury for more the middle class. For the middle
I
class,
guess.
yeah.
they're in that kind of zone. And you're right. Those ones in economic downturns can really suffer. So that's where the brand moat comes in so important. But interesting. Yeah. So we'll talk about China because this is quite an interesting thing. One thing that we're seeing in China at the moment is a massive across the board slowdown in luxury goods. So I'll tell you a little bit about it, Hamish. So first, a little bit of context as to what's going on in China. So they are in a massive post-pandemic kind of economic crisis, led obviously stemming from their property sector. But we actually got some new data which shows that their economic slowdown is continuing. So it says China growth unexpectedly slowed to the worst pace in 5 quarters as faltering consumer spending undermined an export boom, putting pressure on policymakers to step up support at a twice-a-decade economic meeting this week. They say gross domestic product expanded 4.7% in the second quarter from the same period a year earlier, weaker than all except one of 28 estimates in a Bloomberg survey of economists. Retail sales rose at the slowest monthly pace since December 2022, showing a flurry of government efforts to juice confidence have done little to reinvigorate the Chinese consumer. So I guess the backdrop is after the pandemic, people have really felt the pinch. The property market is collapsing. So much wealth is tied up in real estate. Chinese people aren't spending money. They are tightening the belt. And that has had a really big flow-on effect into the luxury goods market in China. So it says here, starting in June, Chinese shoppers can snap up a small beige crocodile patterned version of Balenciaga's iconic hourglass handbag for $1,947 or 35% off on the mainland's dominant e-commerce platform Alibaba Group Holdings Tmall. That price is cheaper than what's listed on the brand's official websites globally and major luxury platforms, including Farfetch. There's another example. Balenciaga, part of French luxury giant Kering, averaged a 40% discount on sale items in 3 of the first 4 months of 2024, according to people familiar with the matter, who asked not to be identified discussing private data. The brand has also more than doubled its number of discounted products on Tmall, accounting for more than 10% of its inventory on the platform from January to April, the people said. And it's crazy because during the same period last year, Balenciaga only discounted items in January and at an average 30% discount. It had no markdowns at all in the first 4 months of 2022. So the stats kind of speak for themselves. You can't really hide it because obviously you're just selling these things to consumers and marking them down. But it's odd to see such luxury brands, supposedly, all of a sudden attracting 35 to 40% off, discount stickers.
Yeah, I guess it just gives you a window into how bad things really are for the consumer in China. It's been such a fascinating kind of case study because their economy on a GDP basis is still growing a very large amount. It has slowed down in a big way, but it is still growing. But it's not growing because the consumers are spending more money. It's growing because their export business is very big. They export a lot of goods, and the government has also been spending a lot of money on infrastructure and some other types of initiatives. And so you have kind of strong GDP growth even through COVID, through the pandemic, and then but once that's kind of stripped back, and you look at how consumer spending has been, and it's been really, really rough. And I guess this is just another example of it. But crazy.
Yep. It says a similar trend can be seen with other labels, Versace, Givenchy, Burberry, as we were talking about. They've all slashed prices, some by more than half on Tmall and other domestic platforms in June. Versace's average discount jumped from roughly 40% at the start of 2023 to over 50% this year, according to people familiar with the matter. So,
wow.
But this is the interesting thing, and this is what I was kind of talking about before. Meanwhile, labels at the highest end of the luxury market, including Hermes, Chanel, Louis Vuitton, appear to be faring far better. They've foregone discounts, limited e-commerce exposure, and focused on cultivating high net worth clients, making them more immune to economic downturns.
Right.
So, That's the thing. Right now is a really good test of whether you have a brand moat or not. Like whether you can, as a luxury goods maker, can you rely on your brand? The ones that won't see a drop in sales, they have the brand moats. The ones that are seeing a big drop in sales, probably worth arguing that they don't have a moat. Is that how you see it, Hamish?
I would say certainly. I think you could still say they would have a moat, but it's like I think it's important. Like you're right. I think during an economic downturn, you get to see kind of a strong distinction between two types of brands. Like the brands that are going to be like resilient and have those kind of high net worth clients, and then the brands that are just going to be more vulnerable to economic swings. But I do agree to some extent for sure. That when you're looking for like when you want to invest in companies with brand moats, you want to invest in businesses where customers need they need the product, even though they don't need the product. They behave as if they need the product, and they're willing to buy it even as they cut back on other things. And so in that respect, I definitely agree.
I also like kind of similar to that vein. I like it when the brand moat is in addition to a different moat. So like Apple, for example, they might have started with their innovation, which built their brand, Steve Jobs, iPhone, that kind of stuff. Yeah. But then they worked really, really hard at establishing a switching moat, that ecosystem, that Apple ecosystem. So now you can argue that they have two very strong moats. So I like it when they don't need to rely on a brand, because you're right, over time brands can change. Some brands go out of fashion, some are enduring, and they're the ones like that we really like to see, the enduring brands, like a Ferrari or something like that. Like I don't ever see Ferraris going out of style.
No.
But on maybe some of those ones where you're not sure whether they've got a brand name but they don't have an enduring brand, then it's really helpful if you can see something like what you're saying before, where the consumers actually rely on the products as well.
Yeah, 100%.
Yeah, interesting. But so that's kind of what's going on in the luxury goods sector. I think you're getting US and UK is like cost of living, like Australia, or we're all like kind of cost of living pressures. China is just the outlier where it's just the economic downturn. And the real tightening of the consumer, which is just not wanting to spend, and that seems to be where the biggest problems are for the luxury goods sector.
Yeah, it's a completely different kind of asset markets between kind of some of the Western countries and China. I think probably definitely one of the biggest reasons why, even through the cost of living pressures, Australians continue to spend, Americans continue to spend. A big part of that is because wealth hasn't gone down, and not only has it not gone down, it's gone up. Stock markets are up, property markets are up.
True.
When those, or if and when those come down, that's when people start to feel a lot. There's that kind of reverse wealth effect, and people feel a lot less wealthy, and that's what is happening in China through their property market. I think we've spoken about that a few times.
Yep. Yeah, exactly right. Super high percentage ownership of property. Most of their wealth tied up. 70% of Chinese people's wealth tied up in real estate. Yep. So when real estate prices come down, you feel broke. Easy as that. All right, Hamish, I'm going to chuck it back over to you. What would you like to talk about next?
Let's talk about Google. Google's back. Google's shopping. Google's been shopping again. They're making progress towards a whopping $23 billion acquisition of tech startup.
Wow, that's a big one.
Wiz, yes, $23 billion, massive acquisition. So they're currently in advanced talks to acquire the cybersecurity company, according to people familiar with the matter. God, those people are so helpful, aren't they? Those familiar. Those familiar with the matter.
Some people just know everything.
Yeah.
These people that brand themselves as familiar with the matter, gosh, their stocks are going up in this episode, aren't they?
I like to imagine like a boardroom of like 10 people, and like Wall Street Journal goes in there and just asks them a question, and they just have the answer. Like the people familiar with the matter have spoken.
Yeah.
Exactly. Like it's just the same group for everything.
It's like it's a business. They're like they're like a business for hire. Their business is familiar with the matter, and then people go in. Oh, the people from familiar with the matter.
Yeah. After all this time, it's just an LLC. It's just a company.
Oh, that's classic. Anyway, sorry.
Anyway, so
derailed you there.
So yeah, $23 billion acquisition hasn't gone through yet, but they're kind of in talks. But what is Wiz? So Wiz was founded in 2020, so it's a fresh company, and they offer cybersecurity software for cloud computing. So their platform analyzes cloud infrastructure like AWS, Azure, Google Cloud, and Oracle, for example. Are some of their clients. So they kind of analyze their infrastructure and then check for risk factors that could allow data to be stolen. So it's it's cloud computing, cybersecurity. They have about 900 staff, and they've been growing very, very fast. They had $100 million in annual recurring revenue within 18 months of launching. And in 2023, in the financial year 2023, they had $350 million in recurring revenue. And they claim to have 40% market share among the Fortune 100 companies. So among the big companies of the world, they claim to be the cloud cybersecurity company that a lot of them go to. And along with their enormous growth over the last few years, they've also had enormous growth in valuation. So earlier this year, they raised $1 billion at a $12 billion valuation. So they were valued at $12 billion, even just at the start of this year. And just with Google's offer now of $23 billion, that's, almost 100% increase in value in just like 6 months. So
that's serious. That's amazing. Holy smokes.
Yeah. Especially to go from zero in 2020 when they were founded to 23 billion today is crazy. Less than 4 years.
I want to meet the founder of that company. That is wild.
Yeah, it's very, very impressive. They also have the backing of a bunch of big venture firms, most notably Sequoia Capital. And this would actually be Google's biggest acquisition ever. So a couple of other big ones. They acquired Motorola Mobility in 2012 for $12.5 billion. More recently, they tried to acquire Fitbit for $2.1 billion in 2021, although I think it was slapped down by regulatory restrictions. There was another Nest Labs they acquired in 2014 for $3.2 billion. That's their router kind of business. But yeah, $23 billion is obviously it's a big acquisition for Google.
Yeah. Just looking up Fitbit. Sorry, Fitbit was acquired by Google in January 2021.
Oh, okay. So it went through. All right.
There you go. So it went through. Yep.
So there you go.
But crazy. So that's wild. It's not even like, these are reasonably recent, like not super duper recent besides the Fitbit one, obviously. There's not even a case you can make that kind of like inflation has meant that it's now the largest. It actually just is the largest. Like, it's huge.
Yeah. And I just wanted to look up then how much they paid for YouTube, because of course Google acquired YouTube. And they paid $1.6 billion, which obviously that's a lot of money in 2006, but in hindsight, that's a deal of a century. I think, what do they do now? Like $35 billion in revenue, and we don't really know how profitable they are, if they are profitable, I guess. But they do $35 billion in revenue, so my guess is that they probably make some money.
That's insane.
But yeah, that puts it in perspective. So they pay $1.6 billion for YouTube, but here they're going to pay $23 billion for a cybersecurity company.
Another just off topic, another acquisition that blows my mind as well for how cheap it was looking back was Disney buying Star Wars.
Oh.
So they bought it off George Lucas.
Yeah.
And this seems crazy because they bought it off a single dude, right? So George Lucas, they bought it off him for $4 billion.
Wow.
And which is huge. Like, obviously, George is a very rich man now. But in terms of actually the IP of Star Wars, I think back when they created that buzz around the new movie, which was episode 7, the first one that Disney made,
Yep.
in that saga, I think on one of their special Star Wars days that maybe it was May the 4th, I don't know. I think they sold like $1 billion worth of toys on that day.
Jeez, that's crazy.
Yeah. That was crazy, such a steal. And obviously even though there's been some notable flops, a lot of those movies have made billions of dollars as well. Or not billions, but over $1 billion. So anyway, sorry.
Yeah.
Back on topic.
Yeah. Another crazy one as well is I was just looking up Instagram by Facebook was just $1 billion. And then, yeah, just recently I think it was they valued Instagram at over $100 billion. So,
Jeez.
yeah, there's been some interesting tech acquisitions, but a lot of the really interesting tech acquisitions were about a decade ago. And Google has also been among other tech companies who have kind of slowed down somewhat on kind of the just eating up competition train, just because of the increased regulatory scrutiny that some of these.
So much harder.
It's just it, and I think there's just a lot. Okay, Google just.
Hello, Google. You're gonna have to turn your phone off.
There you go. Yeah, I better do it. But yeah, Google's kind of this is interesting to see because they've certainly slowed down their acquisitions recently. I just took the time to kind of look at their outstanding cases with the DOJ, the Department of Justice in the US. They're actually currently waiting for a verdict over whether or not they used illegal practices to maintain its dominance in internet search. So that's a big kind of antitrust, kind of monopoly, anti-competition lawsuit that's been going on, and that verdict should be coming pretty soon. And then there's also another lawsuit that hasn't started. Well, the lawsuit started, but the trial hasn't started yet around their ad tech business. And so Google's got plenty of regulatory scrutiny already. Which is why it's
backing up.
Yeah, which is why it hasn't been doing too many acquisitions. But this is obviously a big one, and clearly they think that the cybersecurity side of the cloud business is really, really important, probably to get that tech in house for their own cloud business, but also to be able to provide those services to other cloud businesses. And other tech companies see things the same way. There's a number of tech companies that have also done similar cybersecurity acquisitions recently, the biggest being Cisco, who paid $28 billion for a company called Splunk, which is another cybersecurity firm. Yeah, loading up
Acquisitions getting big. Big.
Yeah, 28 billion's crazy. Yeah, it's insane.
Hamish, I think that we should turn the Young Investors podcast into a cybersecurity firm.
I think that's a great idea. Yep. And it can just be, it's pretty low overhead. Like, we can just pull up Google Cloud and just do a quick check, looks pretty good. Should be right.
Yeah, it looks all right. Yeah.
Yep,
I like your files are well organized.
Yep.
Your passwords are good. Yeah, I think you're all good to go.
Yep, that'll be $1 million a year.
And
thanks.
it's like the total like Aussie way of just dealing with cybersecurity. And look, if you get hacked, like, don't worry about it. It's fine, mate. Don't worry about it.
Yeah, it should be right.
It'll be all G.
Yep.
You just do a password reset, you'll be fine.
No stress.
Don't even stress, man.
Yeah.
Yeah. Hey, you want to go to the beach? Let's get some beers, go to the beach.
Yeah, pretty much. Yeah. So there you go.
I think I'm going to short our cybersecurity business. To be frank, I don't think we'd be very good.
No. So we start a cybersecurity business, and then one of the founders shorts it immediately. That's
and then we get hacked.
Yeah, then we get hacked.
That'd be great. Anyway, anything else to talk about there, Hamish?
That's it. That's the acquisition news for the week.
All right, keep us rolling into what are we talking about with ETFs? There's some earnings came out for BlackRock. Is that right?
Yeah. So I don't think we've really ever spoken about BlackRock or Vanguard or any of these big asset managers from an earnings perspective. Not explicitly, but I thought I'd chuck it in there just as a quick. I thought it was kind of interesting to talk about their business, but then also as a segue into just a view at how enormous the ETF industry really is now and how much it's changed over the last 10 to 15 years. But BlackRock, of course, is the world's largest asset manager. They reported their second quarter earnings over the weekend, and they reported revenue of $4.8 billion, which was up 8% year over year. And they generated that revenue on $10.6 trillion of assets under management. So they've got some dollars in the bank in their bank.
It's also interesting at how wide the discrepancy is, like how small of a cut they take when they've got $10.6 trillion in assets under management.
True.
And out of that, they earned $4.8 billion.
Yeah.
Like, I know there's still big sums, but comparatively, it's just, it's quite interesting, I think.
Yeah, you're right. I'm trying to do some quick maths. It's about 0.2%, I guess, per year. Because this is, of course, quarterly revenue on assets that obviously generate for the year. But it is
in
an
my brain, just
small.
like, I know assets under management is not like revenue or anything like that, but it's just like that's my brain kind of like just thinks about it like that.
yeah, it's interesting. So their assets under management was up 13% year over year. So, big growth in people investing through them. And in terms of their revenue, most of it comes from what they call base fees, so non-performance related fees. So the fees related to your ETFs, for example. So there's no performance fee there, and then also for their actively managed funds, there's going to be some kind of base fee that goes to the company, and then there might be a performance fee on top if they do particularly well. But the base fees generated $3.88 billion of revenue. And performance fees were just $164 million, actually.
Right.
So most of it's coming from those base fees. And then in terms of how much of that trickles down to net income, they generated $1.5 billion, $1.5 billion in net income during the quarter, which was up 9% year over year. So you're right. It's like they have almost $11 trillion in assets. And what does it produce? 1.5 billion.
Yeah. It's quite interesting. I mean, it makes sense because, of course, ETFs are such low-cost investment products, which is great. Yeah. Like, that's really good. But it is funny to see that reflected in then BlackRock's earnings results.
Yeah. And, as I said, that's basically all I could really find in terms of what was interesting around their earnings. But I thought it was an interesting segue into talking about kind of the ETF index fund industry because I did find an article that was kind of talking about BlackRock's ETF business specifically. So BlackRock, of course, sell all kinds of financial products, different funds, actively managed funds. But today, of course, one of their biggest businesses is ETFs. Exchange traded funds, so where you can just buy one stock and you can invest in the S&P 500, or you can buy one stock and invest in some actively managed fund. And that whole industry is pretty new. The fund management industry has been around for a very, very long time, but people would just invest traditionally. They would just give money to BlackRock. There wouldn't be kind of a stock that you could buy. But the ETF business it's pretty new. BlackRock's big entry into the ETF business was actually only in 2009. So it was in 2009 that they acquired iShares from Barclays, which is another investment firm, for $13 billion. So iShares is today it is the ETF subsidiary of BlackRock. So if you buy a BlackRock index fund, it'll be called like iShares S&P 500 or something like that, or whatever the whatever the fund is tracking. In 2009, the iShares ETFs business had just $500 billion in total assets under management, which $500 billion obviously sounds like a lot, and it is a lot.
It's a lot, but it's not really.
It is a lot. But today, iShares ETF, so this is just BlackRock, through iShares, their ETFs, the assets under management is $3.9 trillion, which is like an 8x in assets under management in about 15 years. And some of that, of course, comes from...
It's a lot more money.
Yeah, and some of that comes from the assets being more valuable over those 15 years. Of course, we've seen the stock market, for example, go up in a meaningful way over that time. But for the most part, it's the result of an enormous amount of money flowing into ETF products, particularly index funds, as they've become this, and still are, an incredible way, really, for people to access financial markets and to be very diversified very quickly, to kind of eliminate that risk of picking an individual company and being wrong about it. But I just thought that was fascinating that in just 15 years, $500 billion to $4 trillion just for BlackRock.
I've got an interesting stat here as well, that at the end of 2023, the total amount of money managed passively reached a combined total of $13.29 trillion. So that's actually now overtaken the amount of money that's invested actively at $13.23 trillion.
Wow.
So that really gives you perspective as to, because like back in the old days, like nobody was passively tracking the market. The trend was the normal thing to do. If you had wealth, you would give it over to someone and someone would manage it for you. They would pick the stocks or invest in certain funds and they would be trading in and out. It wasn't really just this concept. Well, there was the concept, but it wasn't super popular of just buying the index and just leaving it alone. It was just too simplistic. People wanted the specialized active management, but of course we now know that's quite ineffective. In fact, over the past 10 years, 87% of US large cap funds underperformed the S&P 500.
Jeez,
so that's pretty wild. That's thanks to the Spiva scorecard, that one. So you're right. There's just been this just insane growth in passive investing through a lot of it through, your ETFs, which like through iShares, which is a really, really good trend to see. And I really, really like seeing it. Like to see people actually starting to reject the hypothesis of active management and giving your money over to some bigwig asset manager that's probably going to underperform and charge you for it. Like it's so good, so refreshing to see that passive investing is growing. Because it's going to make a lot of people a lot of money.
Yeah. To add like the other side of the coin, I think as well, it certainly, I think we're probably too early to really fully understand the effect that this will have over time on the stock market, because you do have trillions of dollars flowing into stocks in a way that really hasn't existed for most of the US stock market. For most of the US stock market, you had, whether it was active fund managers or individuals, basically voting with their money on individual companies for the most part, investing and making some kind of, whether informed or not, making some kind of choice to invest in specific companies. Whereas this is a lot of money just flowing into the market without any consideration for the assets that you're buying, except for the fact that they are the biggest. And so
you're right.
I think
it's like what Michael Burry said. What we've said, we've spoken about this in videos before. I actually just put out a video on it. It's like Michael Burry has said that the thing about passive investing, while it might be prudent and a smart strategy and it's worked over time, it has somewhat removed price discovery from equity markets. So the concept of a stock finding its correct value from supply and demand based on people actually analyzing that business. Well, for the biggest companies in the world, we're looking at between like 20 and 30% of their market cap being held by BlackRock, State Street, Vanguard. Yeah, just those three. I'm sure there are other passive funds, ETF providers out there that are also. But you can look at any company in the S&P 500, not even kidding, and you can look at their largest shareholders, and I guarantee the largest shareholders in every single one of them will be BlackRock, Vanguard, State Street. Mm-hmm. It's just wild. So you're right, and we don't know exactly what's going to happen.
Yeah.
There have been some studies kind of trying to examine the effects of, ETF flows on trading volume, because what people are scared of and what Michael Burry's kind of talking about is this concept of an ETF bubble bursting. And because so many investors are not investing in the companies because they're backing the company, they're investing in the companies because they are in an index, that if there's widespread like panic and people want to drop out of the market, then that kind of exit across the board will disrupt the trading volume enough that it will tank the whole, like every share in the S&P 500 very, very quickly, because passive investors have exposure to, every single company in the S&P 500. So people aren't really sure as to what kind of effect it will have. I think it's hard to tell, because there's also some evidence to say that most trading volume, even considering ETF creation, redemption, is not most trading volume is not that process of ETFs creating or redeeming shares.
Right.
So it's who knows what might happen.
Yeah, it's just fascinating to watch. It's kind of, I don't really want to make this parallel, but it's like it's like the creation.
Are you going to?
I'm going to, though. It's like the creation of mortgage-backed securities in the 80s, right? It's like that product is an incredible product that obviously has been extremely valuable in increasing the amount of people who can get access to loans. Essentially, is like kind of the trickle-down effect of that investment product.
Yeah,
but it could become a monster, and it did, right? 35 years later, in the United States. So it's not to say that is going to happen with ETFs, but I think a good idea and a good product, good investment product, can become a monster. And so it'll be interesting to just watch it and see how it plays out. Because I think index fund ETFs, it's been like the last 10 years they've been really popular, especially I guess with social media and people getting more financially literate through social media and the internet. That's where the popularity has really happened. But some of these things can take multiple decades to really play out. Yeah.
I always think about Warren Buffett's quote, where with economics, you can't just do one thing. Like there's always, that's the thing, there's always consequences in economics. So we've seen some sort of trend, and there's always like a consequence for that trend. And what exactly that consequence is and the scale of the consequence, we will have to see. But you can't just have a fundamental change in the way people are investing and that not have some sort of effect.
Yeah.
Hopefully, it doesn't lead to too much, but you never know.
Yeah, you never know. You never know. That is true.
And with that, all right. Is that all we got to talk about, Hamish?
Yeah, I think that's
so.
I think that's
all right.
it. Yeah.
Perfect. All right. Well, thanks, guys, for tuning in, as always. Enjoyed that episode. That was good. Something a little bit different.
Yeah.
I think, besides obviously the Donald Trump stuff, there was no like headline kind of finance topic this week. Normally there's like one topic coming through in finance that like, and I guess this, Donald Trump stuff's big, but it's more politics still than finance. But it was interesting overall. Thanks for joining me as always, Hamish. That was good fun. Thanks to you guys for listening in. Please leave us a 5-star review if you did enjoy the podcast. If you do enjoy the podcast, that greatly helps us out, helps us get pushed up higher in the rankings, all that sort of stuff. Trying to put more effort into the podcast. We should hopefully have a good plan coming up for you to see more podcast episodes, but we'll see how that goes. Don't want to speak too soon.
Yeah.
But with that said, guys, thanks very much for tuning in, and we'll see you guys next week.
See you guys.